At the end of the day, to me, Bitcoin is priced on future expectations of fiat liquidity, period. Bitcoin is the antithesis of fiat. Fiat has no supply cap. Bitcoin is finite. Fiat can be censored. Bitcoin can't. Fiat cannot be audited. Bitcoin can be audited by anybody. And so Bitcoin is the best expression of fiat. And so if there's tightening of fiat liquidity, then Bitcoin is going to be the smoke alarm that shows us that. Bitcoin has been, and I'm not saying that this is how I value and view Bitcoin, but historically Bitcoin has been some combination of a hard money alternative, a neutral reserve asset like gold, and technology. You can make the argument that Bitcoin's macro thesis or macro value is that it is technology plus fiat liquidity.
Bitcoin's latest dip has rattled the market, sparking renewed debate about what's really driving price action as traders watch liquidity tighten across the financial system. The pullback has intensified attention on Bitcoin's unique behavior during macro stress, reminding investors why its fixed supply, censorship resistance, and full auditability have long set it apart from fiat currencies. In moments like this downturn, Bitcoin acts less like a speculative asset and more like a liquidity alarm, echoing weakness in traditional monetary conditions. For years, it has been understood as a hybrid of hard money principles, much like digital gold, and breakthrough technological innovation. Its macro importance flows from both its technological design and the broader liquidity environment that shapes demand. In the midst of this current market pressure, Bitcoin is showing clear signs of strain, with volatility rising and bearish sentiment building. As of November 20th, 2025, Bitcoin trades between $85,000 and $92,000, slipping from a brief rally toward $93,000 after several impactful market developments. Technical patterns are warning of further downside, with meaningful support possibly emerging closer to the $85,000 level if sellers continue to dominate. Broader financial dynamics, ranging from tightening liquidity to shifts in institutional appetite, are playing major roles in the current decline. It's within this context that Jack Mallers' recent comments to Kitco News feel especially timely. He emphasized that Bitcoin's valuation is inseparable from fiat liquidity cycles, framing it as a defense against the relentless dilution of purchasing power caused by traditional monetary expansion. Mallers highlighted Bitcoin's strength as a finite, transparent asset standing in direct opposition to the boundless nature of fiat currency systems. So, the big question is, what could be wrong? Is there any hope or light at the end of the tunnel? Let's take you back to Jack Mallers' latest market update, where he reminded everyone that Bitcoin has survived worse, thrived under pressure, and historically turned dips like this into the spark for explosive recoveries.
I think broader markets in risk are selling off, just generally speaking. Bitcoin tends to lead that because Bitcoin tends to be one of the only accurate smoke alarms for fiat liquidity we have left in the world. And I hold the thesis that that's because Bitcoin's the only truly free market that we have left in the world. But what I think markets are going through right now is really trying to digest what has become a complicated liquidity situation. So, I actually, as preparing for this show, I pulled up my US liquidity index. The US liquidity index that I look at is down 10%, a little over now, over the last 6 months. So I think the story is this Trump administration came in, they campaigned on lots of liquidity, reindustrialization, lots of GDP growth. And that narrative was a little confusing with Elon Musk and Doge, and that Elon Musk was going to send us into austerity by running the US government like a lean startup. And then that didn't work. And then we had the trade wars and we had Liberation Day. And after Liberation Day, there was taco, Trump always chickens out. And the markets then front ran liquidity. You saw Bitcoin separate and front run what the markets assumed to be more liquidity coming, that there was going to be a truce with China, tariffs were going to be a little bit more mild than they were advertised to be, and that the US would find a way to work with the Federal Reserve and reindustrialize this country and print lots of money to make whole on the promises of the campaign. And I think that hasn't happened. Most specifically that I want to highlight is in September, the US government ran a $200 billion surplus. So that is an annualized surplus of over 2 trillion. And then in October, the government shut down. And so this has been one of the tighter liquidity periods for markets generally. I think the combination of AI, this administration, and the lack of liquidity follow through, markets are just trying to wrestle with. And so Bitcoin is correcting back towards where it was before this administration got going, because it's unclear where the liquidity is going to come from and when it's going to come. At the end of the day, to me, Bitcoin is priced on future expectations of fiat liquidity, period. Bitcoin is the antithesis of fiat. Fiat has no supply cap. Bitcoin is finite. Fiat can be censored. Bitcoin can't. Fiat cannot be audited. Bitcoin can be audited by anybody. And so Bitcoin is the best expression of fiat. And so if there's tightening of fiat liquidity, then Bitcoin is going to be the smoke alarm that shows us that. And so I actually put out a post on X over the weekend where I said, gold making new highs this year shows us that governments and central banks have to print, but Bitcoin falling from highs right now shows us that they might have a liquidity crisis before they're forced to. And so I think the two assets play different roles, and that Bitcoin is a very accurate smoke alarm of where liquidity is today, rather than the gold market is sniffing out where this is inevitably going, right? We know QT is ending, QE is going to have to restart, rate cuts are coming, and there's all sorts of stimulus, whether it's Fannie Mae, Freddie Mac, a housing crisis to be declared in 2026. So I see this as a buy the dip opportunity. The way to monetize a currency failure is to not bet that the stock market's going to go down 50% like Michael Burry and have your fund shut down. The way you do it is by owning a better currency than the dollar, which would be something like gold and Bitcoin. So this is a buy the dip opportunity for me. I think liquidity has to come physically. There's no other option. And this is just a mere reaction to the lack of follow through from the administration. You know, Bitcoin has been, and I'm not saying that this is how I value and view Bitcoin, but historically Bitcoin has been some combination of a hard money alternative, a neutral reserve asset like gold, and technology. You know, you can make the argument that Bitcoin's macro thesis or macro value is that it is technology plus fiat liquidity. And so it's been relatively correlated to the NASDAQ with the properties of gold. And so the market is still trying to figure it out. But the way, again, I would encourage everyone to pull up a US liquidity index chart and a Bitcoin chart, and they're relatively correlated, which is, I think, what we all want. We all want the best expression of fiat debasement, that we all want to own something that is the opposite of someone being able to print time and energy out of a central bank while I have to get up out of bed and work for the currency. And so I think the market is still maturing in its ability to price Bitcoin. Gold is definitely leading in where the world is going. And Bitcoin is acting more as a real-time index in how that progress is working towards the inevitable future, which is we're living through a sovereign debt crisis. I mean, at the end of the day, that's the problem, is that these sovereign nations are in way over their head. And gold is sniffing that out. We're going to have to reprice the world around us in a significantly weaker dollar. And Bitcoin is taking us along that journey. But in part of you're exposed to more volatility with Bitcoin. You're exposed to more of the extremes, but that's to both the downside and the upside. And so, you know, to each their own, I prefer owning the best performer. And so these are buy the dip opportunities for me, and 25% off highs during a liquidity crunch where the government shut down and is reporting surpluses and $200 billion is no problem for me.
Yeah. I mean, what has to happen for Bitcoin to bottom? Is it ETF inflows returning? Is it that macro stability? Is it forced sellers wash out? Or does spot demand need to kind of return? Or has it bottomed out here, right?
We could be, listen, could Bitcoin go to 85, 80? Probably. But, you know, I think there's two things. There's a really healthy cleanse of narratives within Bitcoin. I think that there was the narrative was ETF institutional demand. Well, a lot of the ETF flows are the basis trade, is, you know, arbitraging futures with the ETF. And then there was the Bitcoin treasury narrative, which we can talk about as I'm the CEO of 21. We're not a treasury company. We think we're substantially different than that. But there was this idea that institutions were gaining exposure to Bitcoin through these Bitcoin securities, and that there was an MNAV premium to that. And a lot of that's unwinding, which I think is very healthy. And so I think we'll find a bottom when the market realizes that Bitcoin doesn't trade in 4-year cycles, and that a lot of the institutional narrative was a little bit overblown. But right now people are freaking out. Like, oh my gosh, these institutions, they're unwinding from their ETF positions and they're unwinding from strategies MNAV trade, when in reality, I don't think it was ever really there at the size and scale that it was purported to be and that the narrative conveyed. And that Bitcoin doesn't operate on 4-year cycles like horoscopes, like it doesn't align with the stars. It operates on expectations of fiat liquidity, which is what it was designed to do. And so I think once the market relaxes, calms down, then we move on to this next chapter of liquidity. I mean, we're hitting the bottom of the liquidity cycle. That's what I would say here on Kitco. I'm not going to call any Bitcoin bottoms, but QT ends, it's November 18th. QT ends December 1st. The Fed has said they're going to have to start expanding the balance sheet. Just for context, peak Fed balance sheet, we're at $9 trillion. Now we're close to $6 trillion. That is an insane amount of tightening. Never have we tightened more. People often say, well, if China and Japan sold all their US treasuries, then we'd really be in trouble. China and Japan can both sell all of their treasuries at the same time, and they wouldn't have that much impact that the Fed has had over the course of this tightening cycle. And that ends in less than 2 weeks. And so tightening is over, QE is resuming, rate cuts are coming, and there's all sorts of stimulus that is coming from the Treasury Department, whether it's Fannie and Freddie Mae, deregulation, stimulus checks before midterms. And so I think we're bottoming out in the liquidity cycle. So Bitcoin is really figuring out its identity, understanding that these Treasury MNAVs might not have been the right narrative, that understanding the ETF participants. And I think liquidity will resume, will turn up, and Bitcoin will be the best expression of that. That's the prediction I'm willing to make on the show without you pinning me to a price.
Broader risk markets are broadly selling off, with Bitcoin often leading because it acts as a reliable indicator of fiat liquidity conditions. Bitcoin's unique position is due to its status as the only truly free market remaining, reflecting real-time liquidity challenges. Over the past 6 months, a key U.S. liquidity index has fallen by over 10%, signaling tighter market conditions. The Trump administration's initial promises of abundant liquidity and growth did not materialize as expected, with trade wars and government actions further complicating liquidity. Notably, the U.S. government ran a surprising $200 billion surplus in September 2025, followed by a government shutdown, contributing to a tight liquidity environment. While gold is hitting new highs, signaling inevitable money printing, Bitcoin's current decline suggests a liquidity crunch is imminent. The Federal Reserve's quantitative tightening ends soon, making way for renewed stimulus and rate cuts that should restore liquidity. Bitcoin's ongoing price correction reflects markets grappling with these uncertainties and changing narratives around institutional demand and liquidity cycles. Let's hear more from Jack Mallers.
Did ETFs make Bitcoin more fragile in moments like this?
No, I don't think so. In fact, I think the opposite. But there's two real core narratives that the market needs to digest in regards to the Bitcoin ETFs. One is this basis trade. So you're seeing large banks like Goldman Sachs or trading firms like Susquehanna, what is reported as massive Bitcoin positions. And maybe they are taking a directional position on Bitcoin, but the reality is they're running this basis trade where they're able to buy the Bitcoin spot ETF and sell the futures on the CME and capture a spread. And if that spread is returning them more than Fed funds, then that is the equivalent of better risk-free returns for these capital allocators. And so what looks like massive ETF inflows is actually also realized as sell pressure on the futures. And so there's been a misguided narrative that Goldman Sachs cares about Bitcoin just as much as I do. I don't think that's true. I think that they're trading a spread and they're making these markets more efficient. However, it is true in other circumstances, like we've seen Harvard. Harvard has one of the largest Bitcoin positions of any endowment in the world. I think it's one of their largest ETF positions within the endowment, period. Now, those positions are real. And the really important part, Jimmy, is there's been more Bitcoin OGs of folks that have been sitting on thousands of coins for over a decade that have been realizing profit. And so actually more than 50% of Bitcoin that has been acquired is underwater right now because there's been a massive rotation of a lot of folks. Almost think of it as an IPO moment where lots of early investors are realizing some liquidity and some gains. And a lot of the folks like Harvard, like firefighter pensions, they are actually using the ETF to soak up a lot of the liquidity. So I would say it's both. Part of the outflows that you're seeing is because the basis trade is no longer returning more than Fed funds. And you see this kind of cyclical wind and unwind, wind and unwind. And you can track that just by how profitable the basis trade is. But what's encouraging is all the endowments and the pensions that are buying for the long term and treating Bitcoin like a hedge against future fiat debasement.
You're not saying Bitcoin is kind of exposed to the same structural risk that broke the Treasury market back in 2019?
No, 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 not at all. I mean, these markets are fairly standard and fairly simple, right? You're taking a neutral position on the asset and you're providing liquidity and efficiency to the marketplace. I would argue that it's not necessarily a bad thing. It's good that we have really efficient liquid markets so that, I mean, Jeremy, we saw someone sell 80,000 Bitcoin in one day and the price didn't move. And so it's really good that we have highly liquid markets. That's what you want out of a neutral reserve asset is salability, liquidity. So it's all good. It's just the market needs to digest kind of what's been liquidity dislocation. There's been a lot of campaigning and future promises on printing money, reindustrializing, ending QT, starting QE, go, 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 go. And then we ran a surplus and then the government shut down. And then, well, who's actually net long these ETFs? How important is the basis trade? Well, what are these treasury companies? I see the market just gathering itself a little bit, which is obviously, if you believe in the thesis that currencies have to continue to be debased and the sponge of sorts to absorb the excess liquidity that sovereigns have to print is going to be gold and Bitcoin. This is a great opportunity to add to those positions. I think it's really that simple.
I got to ask you, I mean, when we're talking about the Bitcoin basis trade, and it's kind of being artificially inflated because the futures market is over financialized relative to spot. I mean, would you support regulators tightening leverage limits for hedge funds running this type of trade?
I mean, to be honest, I'm a free market guy. It's hard for me to advocate for the perfect amount of regulation. I'm more libertarian than anything else. I'm not really into politics, and I think less regulation is better. Humans are plenty capable of governing themselves through the free market and having to realize consequences of the decisions they've made. So,
but would you support? Would you kind of support a redesign of a Bitcoin ETF, for example, requiring 100% spot backing and no hypothecation?
Sure, absolutely. Yeah. And what I would support the most is a free market where all these products can compete against each other and let customers choose what do they want. Do they want more comfort in knowing that there's no rehypothecation? Would they want cheaper pricing? And I think the market will inevitably get there, unfortunately, because of politicians and over-regulating is what we tend to do. It becomes really bureaucratic and slow. But free markets are the best way to govern a society and a marketplace, and we'll get there. And that's what I advocate for if I were in charge.
I was reading, some stories this morning, and they're talking about how option traders are loading up on the $85,000 and $80,000 strikes. I mean, how much of this move is real fear, and how much of it is option-driven structure and positioning?
I think that's what the market has to figure out. And for someone like myself, I don't really care. The really cool thing about this is if you have a low enough time preference, none of this matters. I mean, the financial system is going to collapse if they don't provide the liquidity to keep it going. And we all know that. The question is, are we going to need a bank collapse? Is someone going to have to blow up in the repo market? Is the stock market going to have to go down 20% like during Liberation? I mean, Liberation Week, where we all felt so awfully liberated, everyone thought it was a Great Depression. And then markets rallied to all-time highs only weeks afterward. And so the question is, it's a when, not an if. Now, short-term speculators, that's not me. That's not my game. What I do think is important is that markets really flush out a lot of the narratives that are maybe inconsistent with the truth. And that's what I find encouraging is that I think Bitcoin's going to really find its identity. I was also, just because I was curious, looking up Google Trends. How popular is Bitcoin right now? And it's at its lowest level over the last 3 to 5 years. And so I think Bitcoin is going to really grow into a natural, truthful identity on the back half of what has to be an incredible amount of stimulus from sovereigns.
What's the next one thing that has to change next cycle?
Well, Strike, we launched Bitcoin-backed lending earlier this year. And we've become one of the largest Bitcoin-backed lenders for retail in the world. And I give you that context because it's the biggest utility use case of Bitcoin I've ever launched in my life. And I was an early pioneer for Lightning. I was very involved in El Salvador's story. But allowing people to borrow and earn liquidity against their Bitcoin without selling it and without incurring a taxable event has been a massive opportunity for the market. And we estimate the size of this market is only about $25 billion in size against a $2 trillion asset. And so we think that there's a huge opportunity to actually build credit markets on top of Bitcoin, which do allow. So for example, some of our customers, they're borrowing against their Bitcoin and they're putting a down payment on a house. They're borrowing against their Bitcoin. They're putting their kid through school. They're borrowing against their Bitcoin. They're financing an emergency medical surgery. And the interest that you're accruing on the Bitcoin is far less than the accumulation and the performance that Bitcoin has against debasing currencies. And so you also avoid the taxable event. And so we're seeing Bitcoin actually impact everyday lives as a money, not by necessarily spending it, incurring taxable event, and Gresham's law, you're not incentivized to spend it, but borrow against it, and building technology that makes it transparent, reliable, efficient, cheap. And so I actually am a big believer that that's the next step, is that if everyone can accumulate Bitcoin and then just get liquidity, whether it's lines of credit, whether it's termed loans, against it so that they can hoard it and benefit from what is now called the debasement trade, while still being able to benefit their life so it doesn't just sit under their mattress.
Jack Mallers explained that Bitcoin ETFs did not make Bitcoin more fragile in recent market events. Instead, they helped by increasing market efficiency and liquidity. He described two key narratives about Bitcoin ETFs, focusing mainly on the basis trade. This trade involves large financial institutions like Goldman Sachs profiting by buying Bitcoin spot ETFs and selling futures contracts on the CME simultaneously to capture the price difference, providing better risk-free returns than traditional Fed funds. This activity appears as massive ETF inflows, but also creates sell pressure in futures. Mallers noted that some institutional investors, such as Harvard's endowment, hold large real Bitcoin ETF positions, using these ETFs to absorb liquidity. He highlighted that many early Bitcoin holders are now realizing profits, and more than half of Bitcoin investments are currently underwater due to recent rotations. Regarding market stability, Jack Mallers rejected concerns of structural risks, similar to past treasury market problems, emphasizing that Bitcoin markets are efficient and liquid. He pointed out that efficient liquidity means even large Bitcoin sales don't drastically move prices. While some worry about regulation on trading leverage, Mallers advocated for free market solutions, trusting market forces and competition to shape Bitcoin products. Additionally, he stressed the growing utility of borrowing against Bitcoin without selling it, enabling people to access liquidity for real-life needs while retaining their Bitcoin holdings. This lending market remains small relative to Bitcoin's overall value, but it is a significant development for its use as money. As we conclude, how do you think this influences its price behavior compared to traditional fiat currencies during periods of monetary tightening? Please drop your thoughts in the comments below, share this video, and hit your thumbs on the like button. Thanks for watching. Don't forget to subscribe.